This is Boom Bust, and these are the stories that we're tracking for you today. First up, Janet Yellen makes her first official appearance as chairwoman of the Federal Reserve. We'll tell you what she had to say and what to expect from her new regime. Then we have renowned economist Paul Craig Roberts. He's on today's show. He's talking gold, default, U.S. economy, and much, much more. You definitely cannot miss this interview. Plus, we have renowned economists. Yep, well, I just told you that. What am I doing? Now, in today's big deal, we have renowned economist, in my opinion, Edward Harrison. He's discussing why Apple removed a popular Bitcoin app from its App Store and what this means for the systems that help out Bitcoin in the first place. It's all coming up, and it all starts right now. Topsy-turvy day. Now, our lead story, Janet Yellen. All eyes on Wall Street were fixed on Capitol Hill Tuesday as Janet Yellen, chairwoman of the Federal Reserve, delivered her first public remarks to the House Financial Services Committee. Now, Yellen said that only a, quote, notable change in the outlook for the economy would prompt policymakers to slow the pace of tapering. She went on to say that financial market turmoil doesn't pose a major risk to the outlook for the U.S. economy, repeating the Fed's statements that asset purchases aren't on a preset course, so pretty much more of the same. However, one thing that's not the same, the clear sky, smooth sailing conditions that J.P. Morgan Chase is so accustomed to. Now, that $13 billion settlement that J.P. Morgan worked out with the Fed way back in November, the federal government that is, it caught the attention of both Washington and Wall Street. Now, the landmark settlement stemmed from accusations that the bank overstated the quality of its mortgage securities sold before the financial crisis. However, a lawsuit filed on Monday by the nonprofit group Better Markets has challenged the constitutionality of the deal. In the complaint, Better Markets argued that the Justice Department violated the constitutional principle of separation of power when it unilaterally struck the deal without a judge's blessing. Better Markets is seeking to have a judge approve an injunction that would abolish the deal unless the Justice Department provides a, quote, ample and detailed record so such courts may review all the facts and all the circumstances. And one Washington shenanigan slated to go ahead with relatively little drama, the passing of a clean debt limit bill. Who knew? Now, Republican leaders in the House of Representatives caved to demands by President Barack Obama on Tuesday and agreed to advance legislation raising Washington's borrowing authority without conditions. Well, there you have it. What a pleasant surprise. American economist Paul Craig Roberts was an assistant secretary of the Treasury under Reagan and co-founder of Reaganomics. Since then, he has been an editor and columnist for the Wall Street Journal, Business Week, and Scripps Howard, amongst many other media outlets. Now, in that capacity, he voiced his concerns about the strengths of the U.S. economy, U.S. politics, and U.S. civil liberties. I started off by asking Roberts if he thought the U.S. would ever default on its debt obligations. Here's what he had to say.
It'll never default because it can print the money to pay them. See, the U.S., its debt is in dollars, so it can always pay its bonds. Now, all the money printing may cause a high inflation, and so the real value of the bond may fall dramatically. But there's no chance of them defaulting on the bonds. The danger that the country faces is, will the dollar's exchange value collapse? Will the dollar lose its role as world reserve currency? You see, being the reserve currency is extremely important. It means you can pay your bills simply by printing money. I mean, other countries can't do that.
It's a nice thing for the U.S.
Yeah. So the power of the United States and its financial hegemony over the world depends on the dollar having this role. But if they keep printing $1,000 billion every year to bail out the banks, it's going to undermine that role for the dollar, and the exchange value of the dollar will collapse, and the power of the United States will decline sharply. So that's why what I think has the Fed thinking about quantitative easing. If it's not really causing the banks to get well, it's merely keeping them afloat, that it's dealing with symptoms and not causes, but it's threatening the dollar, then the policy doesn't make any sense. So it's possible that the Fed is thinking that way. I don't know that they are, but I've been pointing this out to them for several years now, and they may have noticed. And it may have entered their mind, and they may be saying, well, would be a very serious situation. In other words, a dollar failure would be worse than the bank failure.
Now, Mr. Roberts, the last numbers we got on GDP growth were 3.2 and 4.1% in real terms on an annualized basis. Now, the U.S. unemployment rate has now dropped to 6.7% after reaching crisis peak numbers of 10.1%. And the Congressional Budget Office has said that 2014 U.S. federal budget deficit will fall to $514 billion. That's around 3% of GDP. The question is the United States in an economic recovery?
No, of course not. They get those GDP numbers by underestimating or undermeasuring the rate of inflation. So when they deflate the nominal GDP with an understated measure of inflation, they get positive GDP. But if you actually were to deflate those numbers with a non-manipulated measure of inflation, there would be no GDP growth. There's probably not been very much, if any, GDP growth since the economy turned down at the end of 2007. So no other indicator shows economic growth. We still have the decline in real median family incomes, real per capita income. There's no growth in real retail sales or housing. There's no indication. In fact, all the most recent indications are the economy is about to drop off further. The unemployment rate, the way that goes down is because they simply do not count discouraged workers who can't find a job and cease looking for a job. So the unemployment rate measures simply because they don't count those who give up looking for work. The government has a second measure of unemployment, which they call U6, and it counts the short-term discouraged workers. And that rate is almost double the headline rate, the 6.7 rate. And if you count the long-term discouraged workers as well, as the statistician John Williams does, the current unemployment rate in the United States is above 23%. So there's not been a recovery. It's a hoax, just like the terrorist threat. We don't have any terrorism either, but we've got plenty of spying. And the recovery is a hoax. No one is experiencing it. We see increasing numbers of people on food stamps. We see increasing hardship of the population, more pressure on the population. There was no boost from Christmas sales. So the whole thing about a recovery is not real. It's not there, and they've been able to hide it. But I think developments this year are going to make that even harder.
Now, I thank you for bringing up the subject of unemployment, because the unemployment rate seems to be deceiving the Fed. In fact, the Fed's growth forecast for this year is so upbeat, it is reason that now is the time to cut its asset purchase program. It even wrote at the last FOMC statement, quote, listen to this. Now, in light of the cumulative progress towards maximum employment and improvement in the outlook for the labor market conditions, the committee decided to make a further measured reduction in the pace of its asset purchases. Do you think the Fed is overestimating the strength of the economy again?
Well, of course, but that's not, in my opinion, the reason. That's just their cover, and it's not the real reason they're cutting it. In fact, it remains to be seen whether they will continue with their quantitative, with tapering the quantitative easing, or whether they will have to increase it if, as many suspect, the economy continues to worsen. They'll have to, they may restore their quantitative easing. The real question is, what is the Fed goal? Is it still focused on saving the banks, or has it realized that creating the huge numbers of new dollars every year threatens the exchange value of the dollar? And so they can't save the banks and the dollar. If they decide to save the dollar, they've got to stop quantitative easing. I don't think the Fed has actually made this final decision. For now, they can afford to cut back the bond purchases from $85 billion a month to $65 billion, which is still an otherwise unprecedented amount of debt monetization. They can do that because it's tax time. Money is flowing into the Treasury. They don't have to borrow as much for now. So that part of the quantitative easing that was financing the quarterly federal budget deficit, that's eased up on them. Now, that'll disappear later in the year. And so we don't really know what the Fed is going to do. Like I say, the real question is, are they going to save the banks, or are they going to let the banks go to save the dollar? They can't save both.
Right.
Because if you print all this money constantly in order to support the balance sheets of the banks, you're going to undermine the value of the dollar. In fact,
time now for a quick break, but stick around, because when we return, more with economist Paul Craig Roberts. He's talking gold, both physical and paper, so you won't want to miss it. Then in today's big deal, Edward Harrison and I discuss a recent move by Apple that ticked off a bunch of Bitcoin users. We'll tell you all about it. But as we head to a quick break, here's a look at some of today's closing numbers at the bell. Stick around. And we're back with more from economist Paul Craig Roberts. Now, in the second half of our discussion, I spoke with Roberts about gold, both physical and paper. And now there's a lot of talk lately of hot money fleeing emerging markets for safer havens. And this is depreciating emerging market currencies. But not as many people are talking about gold as a safe haven. I asked Roberts if the gold rise might be due to the emerging markets crisis.
By suppressing the paper price of gold, that's done in the futures market, the COMEX market. What the Fed has done by suppressing that, it's made it very cheap for the Chinese and Indians to buy up the actual physical supply of gold. So what the Fed's policy has done is cause a massive gold flows from the west to the east at a low price. See, the gold price is actually established in the futures market, which is a paper market. For example, the amount of paper claims on gold far exceed the gold available for delivery. COMEX couldn't possibly make delivery on the futures contracts if people wanted to settle in gold rather than just settle in the cash price. So the result has been these huge gold flows into Asia at essentially a low price. Now, what's happening in the emerging markets is unclear. The conventional wisdom is that the Fed created so many new dollars, the banks didn't have anything to do with them, and so they lent them into the emerging markets. They flowed into Venezuela and Argentina and these other countries. And that now that the Fed is going to taper and cut back, that this money is flowing back into the United States, but it's still not clear where. I mean, where would it go?
Right.
Particularly with the stock market falling so much. And the other explanation for the emerging market currency problems is that their currencies are being manipulated. It's very easy for a dominant currency like the dollar to manipulate the currencies of small countries. Maybe Venezuela is being paid back. Maybe this is Washington's way of destabilizing the remnants of the Chavez government.
I mean, stranger things have happened, but I want to talk about, like, on the subject of gold. Now, the Bundesbank, they've begun repatriating its gold from overseas out of storage in places like the Federal Reserve. Now, you've said that you think the Fed, as you mentioned before, doesn't have enough gold to go around if everyone wants to start claiming it. Can you explain this a little further?
Well, the Fed wouldn't give Germany its gold back. I think, if I remember correctly, Germany's deposits with the Fed is 1,500 pounds, 1,500 pounds. Tons, I mean tons, 1,500 tons.
Wow.
And the Fed said, well, you can't have it, but over the next 7 years, we'll give you 300 tons. That will give you a fifth of what you trusted us to keep for you. Well, why would the United States tell its most important European ally that it could only return a fifth of the gold that it left with it on trust if it had the gold? And I think this last year, the United States actually only returned 5 tons.
That seems incredible to me. Now, if the Fed doesn't have the gold, what will happen when Bundesbank figures this out? I mean, they're learning it as it goes along, but what's going to happen?
I think the Bundesbank has already figured it out. Look, now go back a little bit in time. In 2011, Chavez in Venezuela demanded their 160 tons back. And they got it, but it took the Fed 4 months to come up with 160 tons. Well, now, 2 years later, they can't come up with 300 tons for Germany. So this supports the conclusion of many people who have been active in the gold trade for years, that what the Fed initially did to suppress the price of gold was to lend out the gold it had on deposit to bullion dealers who sold it. And this increased supply of gold into the market helped hold down the price. Now, as they drained their holdings of gold, they had to turn to a new mechanism, and that was to sell naked paper shorts. That is, they go in and they sell a future contract for gold that's not covered. There's no gold to cover it. And that then drives down the price. So that's the explanation for why we see now so much naked short selling, where huge amounts of contracts are dumped on the market at the least opportune times of day. And nobody trying to get out of a position would unload it in that way, because that's the way for maximum loss. It drives the price down the most. So I think the Fed doesn't have any gold. They're having great difficulty to come up with it, and in consequence, there's fear that sooner or later the Western system will not be able to deliver to China the gold purchases.
Right.
In which case, the whole system will just simply implode.
On the subject of paper gold, gold ETF funds, that's going to be my next question. Do you think these funds have enough physical gold to back their exchange-traded fund shares?
Well, it's quite clear that they don't. I mean, the evidence is clear that they don't have enough gold to back the shares. In fact, what has been happening is part of the mechanism for driving down the price of the gold. When you sell the paper shorts, it drives down the price. It causes margin calls. It causes stop loss orders to be triggered, and all sorts of people bail out of the shares. So the very people who are doing the shorting can then step in and buy the shares at a very low price. And these gold exchange funds have very strict rules about who can redeem the shares for gold. And basically, it's only the big bullion banks, J.P. Morgan, for example. And the shares can only be redeemed in large amounts, such as 100,000 shares. So what the suspicion of many gold traders is that these bullion banks conduct these raids on the gold ETFs in order to accumulate the shares, then loot the ETFs of the gold so that they can make the gold deliveries to India and China. So it's part of the movement of the precious metal out of the West into Asia.
Sadly, that's all the time we have for now. Please come back on the show very, very soon and enjoy the warm weather in Florida.
Pleased to be with you.
That was economist and former Assistant Secretary to the Treasury, Paul Craig Roberts. Time now for today's Big Deal. Edward Harrison joins me now to talk digital mobile payment systems. Fun stuff. Now, several days ago, Apple banned the last remaining Bitcoin wallet from its App Store. What is a Bitcoin wallet, you may be asking? Well, it's an app that allows Bitcoin payments simply to conduct by scanning a QR code. Now, the wallets are designed to be easy to use and reliable while also being secure and fast. However, the move by Apple to nix the app Blockchain, one of the most popular Bitcoin wallet apps on the market, has angered Bitcoin supporters, and with over 120,000 downloads, it's easy to see why. Now, Apple cited unresolved issues with the developer as their reason for banning the app. However, the makers of the app have accused Apple of trying to eliminate rival money transfer systems that could potentially threaten Apple's own ambitions in the mobile payment world. You didn't think Apple was going to sit on the sidelines for this whole cryptocurrency craze, did you? You didn't, right? Couldn't possibly. Ed, now my first question to you is, what do you make of this latest move by Apple? Why would they do this?
Well, two reasons. One that they gave in terms of, the people think that, in fact, Apple is a rival to Bitcoin in the sense that it's going to bring out its own e-payment system. And the other is actually security, because we're right now having a big problem with Mt. Gox and other places because of an attack by hackers on some security vulnerabilities that they're seeing with how they're developing their software.
Okay. Now, Ed, with the availability of these virtual operating systems, could Apple's actions prove immensely detrimental to the growth of cryptocurrencies in general?
I think that it could be detrimental in the sense that we're going through sort of a hyperbolic phase in terms of the value of Bitcoin. And so, to the degree that it suppresses the availability of Bitcoin and the ability to, get your money out, I think that that phase is going to come to an end. And so we're going through a phase shift from the early adopter phase to sort of the mass phase, and there's going to be a shakeout in terms of who the agents are. And I think that's going to be detrimental over the medium term, but over the long term, I think that Bitcoin will still be a factor. Always
bullish on Bitcoin. I actually just read a tweet that at least ATMs are still working today, and it's like, touche. What are you going to do about that? But is there a vulnerability to all Bitcoin wallet software companies? Are they in trouble? Could something like this happen to all of them?
Well, that's what you were I was talking about before. And, I wrote up a little bit about that because, let's just talk about how Bitcoin works. Because, Bitcoin is basically an internet-wide distributed network of transactions. And, to make sure that the transactions are all confirmed, the owners of Bitcoin are correct, you have to have the Bitcoin miners there owning these ledgers. And the ledgers contain the transactions. Now, the thing is that the miners turn these transaction IDs, these transactions, into hashtags using a cryptographic hash that's based on this cryptographic format called SHA-2. And take a guess who actually created this particular cryptographic system.
Edward Snowden.
Very close, the NSA.
So Edward Snowden.
Yes, exactly. So that's another point we'll get to. But it's similar to the one that when you download software off of the internet, there's a code that comes out and it says the code that you've just downloaded or the program you just downloaded is actually the program that the person who put up the program wants it to be. So what the thing is it takes 10 minutes for these miners to transfer these transaction IDs into these hashes. And you need 6 of these hashes in order for it to be a confirmed transaction. So that's a whole hour for the transactions to go through. Now, no one wants to wait an hour.
No.
And so as a result, these Bitcoin wallets are actually putting through these unconfirmed transactions before the 60 minutes is up. Oh. And that's where hackers can get into play, take advantage of the vulnerability, and then spoof these transactions.
Now, I have one quick question. Are the miners kind of operating as the bankers, if you will?
It's sort of like, if you think of like BitTorrent, it's sort of like a distributed network. There are nodes. These are the full nodes within the actual system, and they're the ones that are keeping everything distributed and in concert with one another.
Huh, wow. Interesting. Fun facts. I always love learning more about Bitcoin. But that's all the time we have for now. However, you can see all segments featured in today's show on YouTube at youtube.com/boombustrT. We also love hearing from you, so please check out our Facebook page at facebook.com/boombustrT. You can also tweet at us at Aaronade, at EdwardNH. From all of us here at Boom Bust, thanks for watching. See you next time. Ciao.